And I think you again have these two perspectives, that of a banker and again that of an investor. Do these differentiate? How do they really differentiate? What goes on in your head when a founder walks in and starts his pitch?
So for me, I don't wear the hat of a banker. A true blood banker is very transaction driven. Unfortunately, I don't have that DNA in me. And I've accepted that early on so that I don't fool myself that I need to be shrewd, ruthless. And that's a good thing for bankers to be, right? I think I like to play that hybrid role where as in sort of we don't have an active pipeline where we sort of invite people and say, come and pitch to us. So a lot of our investments that I've made, starting from the first one till the most recent one that we did, were all through a referral network. Someone's telling us to meet a founder early on, and there's not been a single case where we have done something from an inbound perspective where people have written to us. It's always been, I mean, when you're 16 years in the ecosystem, you're always getting access to deals. But again, we are picking deals where we can be a part of the journey. We're not picking, again, we don't passively invest, neither do we do only transactions. So that's why I said in the beginning, there's a lot of opportunity loss for us because a lot of them want us to come and put that K to 500,000 and not do anything beyond that. We don't operate like that. So for us, we lose a lot of opportunities. But at the same time, what gives us the sort of drive and purpose every day is that we're working with a founder through their journey, through his or her journey. And there have been so many cases. If I take an example of Bounce is an electric vehicle company, started as a mobility platform. They've raised Series A to Series F, gone through their own peaks and troughs. Sorry, they've raised a seed round. We got involved in the pre-Series A where we also invested. Then we helped them get Axel Sequoia and multiple other investors. They're now at a Series F. We continue to work with them in the Series F. Right, so that's the journey that we like. Now, in this, we have missed working with a Zip. We've missed working with a Vogo. But that's okay. A transaction advisor would look at it that where can I do so many more deals in mobility? Where like can I do one deal in mobility and work with that founder through and through? Another example is StockGrow, stock market education app, invested in the seed round, worked with the founder over to raise over, I think, 80 to 100 million over his 5-year journey. I think they will list in the next few years. Grown from zero to $200 million revenue in 5 years. We've been involved. We continue to be involved with them as an advisor, helping some of the early investors that we had only gotten get some secondaries and go out. Now, in that whole 5-year journey, we've seen hundreds of stock growths come into the market in the different shapes and forms, right? Opportunity loss. But what was our drive and purpose? Working closely with Ajay, sort of through and through. Another example on enterprise tech is a fintech platform called EQL, which runs brands like India Filings. They're the largest incorporation and tax filings company in the country today. Again, invested in a pre-seed, pre-series A, brought in through our advisory, brought in BNext, ICICI Bank, helping them raise another round now. Relationship has lasted for 6-7 years. Now, one may say you only earn through success of your transactions. No, I think that's the beauty of being an advisor. You are retained into the business. You're also a shareholder. So there are a lot of things that you can get from this seat at the table. A lot of
How do
perspectives.
you go about evaluating these startups, though, right? I mean, what did you see in those folks that you mentioned right now? When they were in pre-series A, seed stage, what made you realize that these are the folks that can go with me till series F?
See, one is they come through a referral network. Two is the founders have a particular sense of, like I said, presentation, how you represent. Out of the 30 portfolios now, four of them of the 30 investments we've made, 3, 4 companies don't exist anymore. But I think for us, we don't go by age. So we've also invested in founders that are 50 plus. A lot of VCs do not even touch that. For us, it's really down to how deep you understand your execution capabilities, how deep you understand what are your gaps, and what are you going to do to fix your gaps.
Yeah.
And I think for us, most of the ones that we've invested in have been mainly focused around this because we are coming in at a pre-series A. There's already some sort of validation during a pre-series A. They'll be at a 40-50 lakh a month revenue. There is some product market fit, some sort of customer validation that they've had. So we are not writing seed checks where it's just at an idea stage, right? So there's already a large part of risk that's already taken out of the picture. So that 40-50 lakh a month revenue that they come with, that itself for us is a starting point. And have they been growing? How well have they utilized, if they've raised money or if they've put their own money, how well have they utilized that capital? Capital efficiency again. Negative capital efficiency we don't touch. Like if you've put 1 crore in the business and after a year or year and a half, the business run rate is still not crossing that 1 crore. It's a problem. And I'm not talking about capex. I'm talking more where you've invested operationally. If that's not adding up, then that for us is a execution issue that you've not really thought through. You're willing to burn that 1 crore, but you've not even touched the 1 crore ARR. Doesn't, these are some red flags for us. Given the stage that we also come in, we are okay to pay that higher valuation. We don't care about losing out on a seed valuation where, a lot of seed firms come in at a sub 5 crore, 10 crore valuation. That's something we did with Neom, and that's reaped us huge rewards. We're at some 150x returns. You can't get that in all of the startups. So that's why we took a decision that given that we are managing family office money, given that we're investing from our balance sheet, we should come at a slightly later stage, and it's okay to pay slightly higher valuation, because valuations will still give you returns of 2 times plus. And we also tell the families not to get greedy. We'll also talk about exit later and why our journey with the company also allows us to be an advisor to the family that's invested in along with us, to sort of guide and tell them when to exit, what's the right time to exit. But for us, this is some of the criteria. And because the stage we come at, the stage itself gives us guidance on what's on some of these execution metrics.
I think one thing that you really mentioned that genuinely stuck with me was the referral bit. I have believed that myself. I remember reading about some report which mentioned that probably 60 to 70% of the deals that happened in the Indian or the US ecosystem were through referrals. And yeah, that shows a lot. But I also interact with so many seed stage founders, and so many of them are either thinking of getting an investment banker, have already been approached by an investment banker when they're trying to raise funds. And most of the times that these bankers have some terms uh, that they agree with and never negotiate on. What do you really think about these things? I'm personally sometimes stuck in the situation when I am there in the call and someone's asking me because I'm not sure what to say. I have uh, not dealt with so many bankers, though I've dealt with more startups at this point and more investors.
What are
How
the
do you,
terms that you're talking about? What are the terms?
for instance, of one term is usually pay us 50K to 1 lakh and we'll get you 10 investor meetings or 5 investor meetings. But of all upfront, how do you usually go about all of these conversations? Do you think seed stage founders should go to a banker? When do you?
It's counterintuitive to my business, but I think given that we are investing and we're advising in a slightly early stage, we're not doing only fundraising. So for us, it's okay. But actually, when you're starting to go to institutional investors, they actually like it when founders reach out to them directly, at least not at a Series A, but at a pre-Series A stage. If you're going out, don't use bankers. We've had the privilege of doing some pre-Series A deals in our journey, but that's because we were investors, and then the ecosystem understands, okay, he's a shareholder, so he's not coming to sell something to us. We also charge retainers, etc., but that's at a slightly later stage. I think there are a lot of marketing agencies, deck creation companies that also, like I said, if you can get access to 500 investor list. If you go online, you pay $9.99, you'll get access to the list. Relationship building takes its own time. Now, does that mean you sent an email that you can get a deal? You may get a meeting. Off chance, you may get a meeting. Does that mean that you can close a round? A lot of people sort of dangle that carrot of, I can get you so many meetings. Meetings mean nothing. Investment bankers play a critical role. It's not a broker. We are not brokers. And a lot of the ones that have survived and done really well, or most of the boutique guys, right? Like Indigo Edge, Veda, O3, Equirus, Meresis, TRMG, they all add a lot of value. And I think if you're going to do your Series A, you can still hire a banker. But pre-Series A, I think the investors like to see how capable you are on your own. And they would like you to sort of come out there and fight early on. But I would recommend not paying people. I think success is the ultimate result here. So pay someone that has helped you through your journey and that has added value through your journey, that understands how to structure a deal for you, not just introduce you to, don't just introduce someone to CreedCap and then expect to get paid 2% or 3%. That's wrong.